year of development. That doesn't mean that there isn't an important role for aid and the international community. I'm just going to check quickly with our organizers that the logistics is working, because I've seen a note that the live stream has started now. I just want to make sure that everything is working properly. Can I ask for a very quick confirmation?
Yes, it's working.
Excellent, thank you. So this new era of development will see tax at the center, but that will come with a central role of international financing, partnership and cooperation. So it's important to keep that in mind. It's also important to keep in mind that tax is not only the main source of development finance, and it is the main source of development finance already for a while, but also in this next phase, it is the most likely to meet the ambition and financing needs of lower income countries. But it's also the linchpin of development finance as a whole. So it's not only a source of financing in itself, it is what governments need as collateral to go into bond markets, negotiate better rates. It is what pays for the kind of investment that are required on public services and infrastructure. And this is exactly what attracts private investment as another major source of development financing. So the benefits of tax go well beyond its own financing potential. They are much broader than that. In fact, I would say that without tax, it's very difficult to imagine any progress in any area of development, from expanding public services on health and education, digital and public infrastructure, digital and physical infrastructure, any measure to enable growth, promoting security and good service-oriented institutions in lower-income countries. All of that requires expansions of the tax base. And that is very clearly reflected also in the Compromiso de Sevilla, as it's been called, the outcome document for the 4th International Conference of Financing for Development, which I'm mentioning because it's happening later this month, the week after next. And it clearly recognizes public revenue as central to securing sustainable development in the longer term. Now, the challenge, of course, at this juncture is that the pressure is so high that lower income countries will inevitably increase tax revenue and introduce new reforms. But how will that happen, and whether they will be successful is the question. Luckily, we're entering this new era with a very strong foundation of evidence. In the past decade, there's been massive scale-up in efforts both to reform tax systems and to produce evidence to go alongside those reforms to illustrate what has worked, what hasn't worked, and how revenue increases can be sustained in the longer term. So we're not going to talk so much about the risks today of poor reform, but there are some really good examples, particularly in relation to tax in the informal economy, which is a separate conversation that has been happening at the ICTD and ATAF and the other organizations represented in the panel today. What we're talking about today is the other side of the spectrum, higher income individuals and larger firms to a certain extent. And I think taxing the wealthy is perhaps the most glaring example of what is possible to do now. And also of the fact that revenue mobilization doesn't have to come at the cost of equity. It's definitely possible to increase revenue while also doing that in an equitable way. And the case of taxing the wealthy lies at the heart of that. It's important to keep in mind that that is not only the right thing to do, it is also the smart thing to do. It is the efficient thing to do, given the limited capacity that revenue administrations have across lower income countries. So I'm particularly happy that we're hosting this webinar on this specific topic, because I think it is one of the immediate things that lower income countries' governments can do to both hit the revenue generation and the equity objective at the same time in the short term, because many of the things that our panelists will talk about are things that are indeed already possible now within the frameworks and tools that already exist. Now, I would be naive if I wouldn't mention that, yes, all of this is possible now. All of this has many benefits, not only on revenue, but also on equity. But also a lot of this hasn't happened despite being technically feasible. And a big part of the reason for that is that many governments and leaders have been unwilling to confront the political realities that taxing the wealthy would require them to confront. So I'm particularly happy that a couple of our panelists today will touch specifically on that political question, as well as the technical issues around taxing the wealthy. So I will end there, my initial remarks. There's a lot more coming, and I will introduce our speakers as we go. The first one is my colleague from the ICTD, Giovanni Occhiali. He's a research fellow at the Institute of Development Studies and at the International Center for Tax and Development. At the ICTD, he leads our work on taxing the wealthy and environmental taxation. He has also a very strong track record across the board with various research projects and publications on tax administration, tax compliance, digitization, in addition to the themes that he leads at the ICTD. And he's now going to kick us off with some framing thoughts on taxing the wealthy in lower income countries before we move on to case studies. So, Joe, over to you.
Thank you very much, Giulia. I hope that everybody can hear me fine. It's a pleasure to be here with you today. I am going to start sharing my presentation and hopefully will contribute to inform the discussion with a bit of background of why it is arguably one of the biggest priority for low-income country to start properly targeting the high net worth individual that they all host. This is a presentation based on a summary brief of all of the work that ICTD has carried out on taxing a net worth individual over the last few years. So without further ado, why would we argue that taxing a net worth individual should be a priority across most low-income countries? Well, there are two main reasons. The first one is that by and large, all low-income countries have a significant imperative to start mobilizing revenue as quickly as possible. If we consider the way in which low-income countries mobilize their revenue, what we can see is that taxes that bear more heavily on wealthy individuals, such as personal income taxes that are levied on the self-employed, or various withholding taxes on rent, taxes on dividend, taxes on interest income or capital gain taxes, tend to be those that underperform the most across all the country group. Most countries, most low-income countries and lower middle-income countries have legislation that cover the taxation of these sources of income. And their income legislation, income tax legislation, tends to be generally progressive in line with international standards. However, once we go and see how much these are enforced, we see that a lot of these taxes are enforced quite quickly. In 2015, for example, only one of the 71 top government officials of Uganda ever submitted an EPAT return. Less than 16% of landlords identified in Sierra Leone during a registration drive had a taxpayer identification number. And this leads to the fact that proportional to their GDP, high-income country raised 3 times as much personal income tax to the low-income country and almost 7 times as much property tax as low-income countries do. So there's a clear imperative to make the tax system of low-income countries more progressive. The second problem is that low-income countries have a big problem with inequality, both in income and in wealth. There is by now significant scholarship that has connected inequality with lower economic growth, with lower intergenerational mobility, low human capital accumulation, and the recognition that these are all very significant issues for development had led to the creation of a specific sustainable development goal, which aims to reduce both within and among countries inequality. Now, while we were seeing progress in this over the last few years, this trend has started to reverse. And interestingly, contrary to common belief, low-income countries in general, and those in Africa especially, are characterized by higher income and wealth inequality than high-income countries. Now, fiscal systems have historically played a significant role in redressing income inequalities, especially in high-income countries. However, their potential to perform a similar role in low-income country has been explored to a lower extent. Now, what can be done about the situation? What can be done about the need of both mobilizing further revenue and to reduce inequality? There's two big school of thought. One that believes that there are limits to what can be achieved given the economic structures of low-income countries. A lot so far to tax smallholder agriculture, petty urban trading, large informal activities. Many of those subscribing to this view think that the priority should be given to general economic development, and that redistribution, especially through increased taxation of the wealthy, can only happen afterwards, once some structural change in the country has taken place. Others are been arguing for a long time for a significant and immediate policy change to increase burden on the wealthy. The introduction of wealth taxes or increasing marginal tax rate are seen as the main way for countries across the globe to start tackling the issues of inequality and ensure that there is a fair contribution of wealth to individuals. Now, much of this debate has been informed by what has been going on in income countries and high income countries. And within ICTD, we generally subscribe to a third view. What we think is that there are immediate opportunities to improve revenue contribution of wealthy individuals within the existing tax system, with only minimal policy intervention, but rather focusing on tax administration. This belief arises because we have seen this happening in a variety of countries. We have seen that in a relatively short time, the Uganda Revenue Authority collected almost $5 million after establishing a net worth individual unit, that a single Nigerian state raised over $1 million, and that in Freetown, the property tax revenue was tripled after an administrative reform in the course of a year. Now, the set of intervention that we're going to be looking at can all contribute revenue and pave the way for the adoption of new policy tools, but they can do so by focusing on a few different administrative constraints. Now, the first things that we have to notice is that improving enforcement and compliance, as well as simplifying the process with which taxpayers have to pay their taxes, is key to increase the contribution of wealthy individuals. A lot of focus should be given to identifying the relatively easy under compliance or non-compliance behavior of many individuals that can already be seen through the use of tax administrative data without the need of carrying out any major reform. Mapping and evaluation of real estate can play a very important role, given that a lot of wealth in the continent is stored in real estate. And then sensitizing taxpayer and simplifying compliance also becomes key. It is important that improving compliance amongst the net worth individual is not seen as a mission against them, but rather as a general way to making the tax system more fair. We have a need to increase administrative resources dedicated to tax administration. Despite a lot of investment over the last decade, many low-income country administrations still have less than a tenth of the tax officer of high-income country, and therefore they have a hard time managing the tax affairs of individual with complex economic activity. And then there's also an argument that can be made that the tax rates for capital, rent, and dividend should be made equal to that of the marginal schedule of the pay-as-you-earn for labor income. Now, what are the obstacles for doing this set of reforms? There surely are some technical complexity, especially when it comes to the identification of assets, both domestically and overseas. But this should not be overstated, as a lot of digitization reform have made easier to acquire this data. However, sharing this data across the institution remains more complex than we could be, because of rent-seeking opportunities that remain when each government institution manages its own pot of potential non-tax revenue. At the same time, not all other government institutions have been digitized to the same extent that the revenue administrations have. The third big elephant in the room, obviously, is that there is need for political support. While technical fixes can help identifying the income of this individual or the individual themselves, this is a different thing than ensuring that they actually comply with existing tax obligation. So every successful reform will entail a combination of different practices that lead to the identification of the main constraints that are leading to this underperformance, and then the development of a strategy that can tackle all of them at once, and will require strong central leadership from both cabinet and the revenue authority. Now, a few policy recommendations that we've seen, and then I'm going to conclude, is that the first things that usually a revenue authority is willing to improve compliance from a net worth individual do is to develop their own internal definition. The definition used internationally of $1 million of net wealth and asset is not really fit for context in which the average per capita income is $3,000 per year. After this set of criteria have been identified, then the creation of a special unit that only looks at the effect of the affair of this taxpayer segment is usually the second step. And that comes together with work on the legal and institutional framework required to strengthen data sharing, both across government institutions and with commercial and professional bodies. Both deploying tax certificates more widely than what has been currently done, and considering the introduction of voluntary disclosure program and one-off amnesties for interest and penalties connected with non-declaration can play an important role. And what we also want to stress is all of these reform should precede, in our view, conversation about the introduction of new wealth taxes, because as long as a country is not capable of enforcing the income tax legislation that is already present, adding new policy, adding new things that the revenue authority should be looking after, might actually end up backfiring rather than contributing to making the tax system more fair. So to conclude, we think that the experience demonstrates that these steps can be implemented relatively quickly. Moving on to the various things we just covered can be done in weeks. They can contribute revenue in the short term. We've seen various examples in which millions of dollars were collected in the course of a year, and this already makes the tax system more equitable and can have wider compliance impact. And as all of this takes place, the data gathered, the administrative capacity built will make other progressive tax reform feasible in the longer term. So thank you very much. This is everything I'm gonna share, and hopefully will help kicking off the conversation.
Thank you very much, Joe. That was great. And I love that you ended with some very practical things that I'm sure will be explored in the other presentations as well. I just want to ask you to elaborate maybe on one point that came through your presentation before moving on to Ronald next, which is this difference between wealth taxation and the debate that is happening globally about wealth taxes and taxing the wealthy in lower income countries through some of the measures that you've highlighted at the end of your presentation. So can you tell us in maybe just a couple of minutes, because I do want to make sure we move on to others, a bit more about that difference between taxing wealth and taxing the wealthy, and what are the complementaries between those two things in the practice of American countries?
Sure, thank you very much. This is a very important question. So I think that the main difference between taxing wealth and taxing the wealthy is one. When we talk about wealth taxes or taxes wealth, we are referring to taxes that are levied on a stock of assets, land, real estate, financial holdings, or on a specific event, inheritance, capital gains. These are the type of taxes that are hotly debated in the income countries because we have very good documentation of asset ownership and we have high administrative capacity in our revenue administration. By contrast, when we talk about taxing the wealthy, we are looking at a broader set of intervention that can ensure that high net worth individuals, however we define them, contribute fairly across all relevant tax handles that they should be paying. So we're not looking at any one specific tax. We are looking at everything: income taxes, rental income, property taxes, so on and so forth. The distinction is crucial because in high-income countries where compliance with income legislation is generally high, and income legislation is, at least in theory, progressive, the debate has rightly moved on how can we tax wealth, okay, over the last few years, especially how can we tax the wealth of billionaires and centimillionaires, and how can we ensure that they pay a fair share of their income and wealth in general. This is important as they are not paying their fair share at the moment. So this is the right focus for high-income countries, and something that I personally fully support. However, when we look at low and lower middle-income countries, we found a remarkably different situation. Existing taxes are not really enforced as they should. Everything that target self-declared income is de facto not really contributing anywhere near what it could. So moving on to introducing other taxes at the moment, before fixing the administrative shortcomings, the political economy constraint, and in context in which political capital for tax reforms is generally very scarce, can actually be can backfire. It can increase the burden of already understaffed revenue administration and end up creating another set of taxes that nobody complies with, right? So I think that really, again, the argument we're making is one of sequencing, right? Like, you start by improving the compliance of wealth individual with existing legislation. And as you do that, you build the capacity both in the tax administration, and you gather the data about assets required to then move on to a more explicit form of wealth taxation and other type of progressive reforms farther down the line.
That's great. Thank you. I think the message I'm taking from you is, it's great to have that conversation about global inequality, about wealth taxes, but when it comes to actual practical immediate action, there's many things that can be done already with the tools that are available. So that's a really useful practical point to end this bit on. Ronald, I will move on to you now. So Ronald Waiswa is working with the African Tax Administration Forum, one of the key actors and stakeholders in this space. He's applied research and statistics specialist at ATAF. Prior to joining ATAF, he was working at the Uganda Revenue Authority as research and policy analysis supervisor. And in that capacity, he has a wealth of experience in how the URA has been doing that. Around the time you were at the URA, Ronald, there were some really good progress, and Uganda has been one of the first case studies that people have been talking about in terms of how to tax the wealthy in lower income countries, and many countries have learned from the experience of the URA. So it's excellent to have you in both your capacity of with your ATAF hat, but also your previous URA hat. And of course, you've got lots of experience conducting research yourself. So I'm looking forward to your presentation. I know you will tell us a bit more about case studies and selected African studies that ATAF has been looking at recently. So I will pass over to you. And as I do that, I would encourage everybody to share your thoughts, comments, and questions in the Q&A box. I can already see 2 of them, so I will feed those through the questions for all our panelists, but please do keep feeding through the Q&A box. Ronald, over to you.
Yeah. So thank you so much, Giulia. And also to add that I worked a lot with ICTD on a number of collaborative studies, starting with the HNW way back in 2015. In the interest of time, I'll go straight to my presentation, which should be short. Because I think I have 8 minutes. Confirm that you can see my slides.
Yes.
Perfect. So I just want to share my experiences on taxing the rich in Africa, where I think I have experiences from over maybe 8 countries now, having started from Uganda. One fundamental question which we usually get is who are they? So who is a high net worth individual for tax purposes? We know that the wealth reports put a 1 million threshold, but that is not for tax purposes. It's for purposes of the wealth magazines. So what I can say and what we have seen is that there is no universal definition for tax purposes. So every tax administration needs to think about what data it has, and then it uses that data to come up with its own threshold or its own definition of who a high net worth individual is. The first efforts were by ATO, the Australian Tax Office, and for them, they started with focusing on executives and directors of public companies earning beyond 1 million Australian dollars, and also executives of large private and foreign-based organizations. And along the way, they adopted the group wealth approach. So where they get the rich together with their companies and treat them together. The same applies to, I think, UK. UK considers a net worth of 20. Now, there are two things I wanted us to pick here. In ATO, they were looking at company executives. And these are some of the things we pick also in Africa. Then UK uses one threshold, which is a net worth of 20 million pounds, which was subsequently reduced to 10 million pounds in 2016. Then in South Africa, what we see, they also consider one parameter threshold, where they are looking at those with gross asset worth 75 million rand. I think I needed to convert this to dollars. But also, the way they look at their high net worth individuals, they consider the individuals together with their companies and trusts. So when they talk about the high net worth individuals they are looking at, they have like 3,000 of them, and then about 500 which are their companies, and then trusts, they are managed together. Then these are the low-income countries like Uganda, Kenya, Eswatini, Tanzania, and Zambia, where I am now. What we have seen is that a one parameter threshold is not feasible. So coming up to say that any individual above this value is a high net worth individual, it is very difficult in an African setting. Why? Because most of these countries, there is a data challenge in most of Africa. So it is very difficult to map someone to say this is your net worth. So in that case, what we are seeing that what is feasible in most of the African countries is using different parameters to try to identify them. A classic example, which is already published, and I'll share this here, and it is overlapping. It is almost similar. Of course, in different countries, you see different sectors coming up, but they are almost the same. They almost invest in the same ways. What we see in Africa, that most of them are property giants. They own a lot of land. They own a lot of property in most of the business centers or the busy urban areas, really. So issues to do with land transactions, issues to do with rental income taxation, issues to do with property taxation, when you do enough on that, is mostly targeting the wealthy. So in Uganda, they have different parameters, and for them, they segment them into core and non-core. What you see in green is what they call the core parameters, and it is the same that we are almost marketing or seeing in most of these African countries. So for them, they look at property. If you're dealing in land transactions above a certain threshold, they're looking at rental, and also multiple shareholding or shareholding in large companies, which is also similar to the Australian tax office, like I mentioned earlier. And then here, what we have seen in Africa, access to bank information is a problem. But many of them declare liabilities in their income tax returns. So the best way to know if you want to use bank information is to use what they are declaring as loans. Because you cannot, for instance, get a loan of $1 million when you don't have collateral security for that. So these are the core. And then what you see in yellow is what is the non-core. So by non-core, ideally, you need to look at 2-3 parameters for one to qualify as a potential high net worth individual. This is ideally the same across countries. So to tax them, there are about 4 essential things that need to be in place. An enabling legal framework, and as you see, these ones I put them in red. What we see is that in all these countries, there are sufficient tools within their tax laws. Of course, there are gaps. When you go to a country, you'll identify this country has this gap, this country has this gap. But in terms of the tools to tax them, there are sufficient legal tools or provisions within the existing legal framework to deal with these. Where the problem is largely administrative capacity, both within the tax administrations, but also within other relevant government institutions that are supposed to collaborate with the relevant administrations to get the relevant information. The other issue is the data. So many problems there on the quality of the data that can support revenue administrations to tax these individuals. And then the political backing, that is a problem everywhere. So when it comes to the legal framework, I've already talked about this. We see there are various provisions to tax different sources of income. The income tax rates are progressive. There are anti-avoidance provisions. Many countries have gone into exchange of information agreements, and there are provisions within their tax procedure acts to access information. However, what we have seen in most of the countries, especially those in Southern Africa, they use a source-based tax regime. The implication of that is that the incomes for most of these rich that is sourced outside escapes the tax net. And it is a common characteristics of these individuals that they will invest offshore. Because of political issues, because of investment reasons, they will shift some of their income outside. Now, when a country is using a source-based regime, it means that the income they are sourcing from other countries is escaping the tax net. And then in some countries, we see, and that's why it is important to do the country-specific studies, you see that some passive income, which are key revenue handles for the rich, like capital gains, they are either not taxed or they are taxed at very low rates. In some countries, you'll find that capital gains are not taxed. In other countries, you'll find that dividends are not taxed or interest from bonds are not taxed within the law. So these are revenue handles that the rich actually use to earn. Now, when they are not taxed or taxed at low rates, then the rich end up contributing little. Then the other thing we have seen is that in Africa, and like in one paper that we published, I think some time ago with ICTD, the most effective way to tax most of us is through the withholding tax regime. That is why the pay as you earn is working, because it is through the withholding tax regime. Now, the purpose of the withholding regime, there are mainly two reasons. The first one, and the most important one in my view, is to enable the tax authority to identify or to correct information. And then the other one is to correct some revenue in advance. Now, what we see is that there are withholding regimes in most of these African countries, but they are very ineffective. Why? Because the tax identification numbers in the withholding tax returns are usually not mandatory. So some declare, but withholding in aggregate. So you cannot tell the withheld from who. And then what we have also seen in the legal side, there is something that is really gaining attention, called the data protection laws. Data protection have been there for some time, but now some countries are enacting data protection laws. And in those data protection laws, the revenue authorities are actually exempted, are not exempted. What they usually exempt are security agencies, but revenue administrations are not exempted. So this is affecting them a lot. On the administrative side, there are so many countries, but most of them don't have structures to deal with H&W. Most of them consider it not to see a lot of money. Where they exist, like in Uganda, they are formal structures. Kenya has formal structures. South Africa, Eswatini, and recently Tanzania and Zambia. These have formal structures. But what we see, that there is a resource problem. Only one country out of these has a staff to H&W ratio of 1 to about 33. Others, including South Africa, is like 159. Other countries, 1 to 100. In another country, 1 to 300. So the resourcing is a big problem. Then what we also saw, and it was a game changer in one of the countries, is that even internally, there is information within tax administrations, but it is not sufficiently used. Why? Because of disconnected working relationships between the H&W units there and existing functions within the tax administration, like EOI. One country, when we flagged that out, used EOI information, and the results were mind-blowing. They identified so many individuals with a lot of potential. Then what we also see is the low level of automation of other government agencies that are supposed to be suppliers of information to the revenue authority. And where they exist, the other issue is that integration that is happening between revenue administrations and government agencies, it is integrations for validation. So they integrate the revenue administration system with the government, another government system, but only for validation, not for access to the information. That is the problem. So integration is moving on, and we have been advocating for integration, but the integration is not effective. It's only being used to validate information, not access. Then the other thing, like we mentioned in the criteria, is that the company executives for the LTOs, large taxpayer companies, these are potential. However, in many countries, the registration of beneficial owners of these companies is very ineffective. Most of them don't have tax identification numbers. In other countries, they are not even required to file tax returns. So those are gaps that are causing challenges. Then there are so many issues we are getting in the administrative side, is the lack of visibility in the transactions of assets, land, vehicles, properties, etc. That you can have a capital gains tax, you can have rental income tax, you can have the property transfer rates, but as a revenue administration, you don't have visibility on who is actually transacting, because usually these are managed maybe by the Ministry of Land, so the deeds office, and that information is stored there, yet most of them have ineffective IT systems. And of course, lastly, interestingly, many organizations there are a few organizations that have mature IT systems. Many are in the development phase or initial stages, actually. They are developing new systems. Now, the problem is that the historical information is lost. Why? In fact, it is both lost, but also it is very hard to use, because then the tax identification numbers were not really unique. So that is causing a lot of problems. So there are so many admin issues that actually need to be addressed. The other one is the politics. Politics is a big issue. And what we have seen in other countries, like I talked about the data protection laws, it is actually influenced by politicians. They bring up a data protection law to stop the revenue administration from accessing some of the information. And these are real things that we have seen. So to do this, it is important for tax administrations to plan for a political approach. One, the support of senior management is really critical. Every revenue administration that needs to move into this direction is not just about establishing a unit. There must be commitment of the commissioner, maybe for domestic taxes, the commissioner generals, all those heads within the tax administration to support the unit. Secondly, it is not just about also putting up the unit. The leadership of that unit is also important. There should be a combination of soft skills and technical. Have the technical people there, but also a person who is able to deal with the politics. That person should have stakeholder engagement skills, should have experiences in navigating complex government structures, should be authoritative at times because of the threats that may come. And then definitely, like I mentioned, there are those cases that are really high level, that need to establish clear protocols for maybe the commissioner generals to engage senior government officials, especially even at times the presidents. Those are ways where we can deal with the politics. Thank you so much for now. Thank you, Giulia.
Thank you, Ronald. That was really exhaustive, and you brought us through lots of really practical cases and examples, ending with the politics. I'll park the politics point because I know we're coming back to it, and I'm seeing some of the questions coming through the chat as well. But I'd like to pick your brains on one specific point that is coming through the chat as well. And it's I'm particularly interested in your views because of your work with the African Tax Administration Forum. So this is a question about the role and value of regional cooperation and regionally harmonized definitions, both for what high net worth individuals are. I've heard what you said about multiple parameters. Can they be harmonized regionally? But also there were two questions from the chat, one from Malika Mahajan about regional coordination to avoid the wealthy move across jurisdictions when things get a little bit more strict in any one specific country. And then another question from Dhirendra Pabari on common reporting standards, particularly in the context of asset identification. So whether that kind of regional integration on definitions, on rules, on identification of assets can actually help prevent some of the challenges related to mobility. And I'm going to ask you to answer this very complex question in a couple of minutes so we can move on.
Yeah. So for the standardizing the definition, I think it makes a lot of sense because yes, these HNWs have really similar characteristics across the country. So like I mentioned, these are mostly company executives, they are property giants, they are people in trade, they are professionals. So these are answers that are coming up from different countries. However, three things. Yes, we can say if you want to define an HNW, these are the indicators. But I think it depends on the data available within the tax administration or the data that the tax administration has access to. You can have all these parameters in place, but you don't have access to them. We have been testing almost 20 parameters. We came up with about 20 parameters, but in most cases, you find that there are only 8 parameters that you can define based on available data. The only reliable data is usually within the tax administration. So if a country, if a revenue administration does not have a proper income tax return, a proper WHT return, it is still a problem, because there is another narrative pushed by digitization, that digitization simplifies. But what we have also seen is that at times simplification can be too simple, that revenue administrations are actually losing the right information that they will need tomorrow. So they are simplifying today, making it easy for taxpayers, but at times it is too simple. Then the other thing that needs to be considered is that the thresholds. I think it's going to be very difficult to say the threshold should be this, even for the different parameters, because we are at different levels of development. So every country needs to look into its data and say, as far as we are concerned, maybe for rental, this should be the threshold. So we can just give kind of indications. And then also doing re-examination within a country, there are unique sectors. There are sectors where we have seen that it is actually illicit trade that is driving the economy. So that one, you have to look for another parameter, or you have to look for other information. So they need to know the sectors that are driving the economies. They need to think about the thresholds which fits within their country, but most importantly, the data.
Okay.
Do
you think you can wrap up your answer within the next minute?
Yeah, I think the other very most important thing in terms of wealth identification, asset identification, I think countries need to appreciate the EOI, exchange of information. Very few countries have moved towards automatic exchange of information. I think countries that have actually achieved that, I'm telling you recently, the stories I had last week in Pretoria when we had a meeting, there is one that decided now to go and make use of EOI about H&W, and the information they got, it was mind-blowing. So let countries embrace EOI. It will help them a lot. Thank you.
Thank you. That's really a great perspective on the regional dimension of it all. It's now a pleasure to call on Ishmael Zulu. So Ishmael is from Tax Justice Network Africa, which has been doing wonderful work in this space and in tax and equity more generally. So Ishmael is Senior Policy Officer at TJNA, working on tax and equity. He is a development economist by training. He has almost a decade of experience in the civil society space at national and international levels, and a wealth of experience, not only in taxation, but also development economics more broadly, program management, advocacy, and policy analysis. And of course, in your role with TJNA, Ishmael, you have been contributing significantly to building capacity and uptake on issues around tax justice, but also illicit financial flows across the African continent. So I look forward to hearing your remarks. I understand you're also going to be sharing some case studies from the African continent. So over to you now.
Thank you so much, Giulia. Good afternoon, everyone. It's afternoon where I am. Yes, well, as Giulia had mentioned, I work within the Tax Justice Network under our tax and equity pillar. And it's interesting to follow this discussion. I'm following the presentation that was given by Giovanni and the remarks which were given by Ronald. And of course, there are a lot of similarities with what Ronald had shared, given that we're both focused on the African continent. But within our conversations, one of the questions that we have been asking internally as TJNA, especially around taxation of wealth, is one of how did we get here? And we ask this question because there is such a stark difference between the wealth that is controlled by a small amount of people versus the others. So numbers on the African continent show that about 10% of the richest Africans control nearly 70% of total wealth on the continent. So there's a huge problem of inequality where a small amount of people control the vast amount of wealth. And then we go back to the question, how did we get here? How did it get here? So we have traced it back to a global financial architecture and system that was put in place decades ago. And this particular system, honing in on inequality and billionaires and wealth specifically, the system has allowed for this in three ways. Of course, this is a submerged version. There's many other points, but we narrowed it down to three ways. So there's the capital versus labor imbalance, and that's the first one. So capital grows at a much faster rate than wages do. So the rich at present get richer by owning assets, whereas workers rely on mostly stagnant wages. Secondly, there is a lot of monopoly power and corporate concentration. And what this means is that there is a handful of firms that dominate key sectors, extracting excess profits. So a handful of firms, these can be firms that are found within the digital services sector, in the exchange of minerals such as Glencore, for instance. And these monopolies generate super profits for billionaires while suppressing wages and innovation, contributing to this large gap that we see between the rich and everyone else. So that's the second one. And then the third one, which is more in line with our bread and butter, is the loopholes within our tax system that allow for tax avoidance and movement of offshore wealth. So billionaires and the ultra rich exploit loopholes within the tax system and pay minimal taxes. And when it boils down to it, you find that the ultra rich pay a much lower effective tax rate than average citizens such as nurses and teachers, and unfortunately. And this system goes beyond and splits now even the developing countries from the more developed countries. That's the global north and the global south, where the relationship that exists between the two is mostly extractive in nature, and there's unequal exchange. And it also perpetuates colonial continuities, where we have seen forms of neo-colonialism. And there have been a lot of conversations, especially for organizations that are focused on tax, those that do work on debt, where we have outlined that the current system is not fit for purpose and needs to be changed. And some have used the phrase, the system is broken. But unfortunately, when you dig into it, you find that the system is not broken per se, but is working just fine. This system has seen this huge gap between the rich and the poor, and it has persisted because there are well thought out global financial and economic institutions such as the IMF, the World Bank, the WTO, that are dominated by wealthy nations. And these generally enforce rules that benefit capital. So perpetuating, this is why it's more difficult to deal with issues of inequality from a systematic standpoint. Now, moving on to solutions and coming back to the discussion that we're having now today, one of the solutions is looking at our tax system. In looking at our tax system, I'll look at it at two levels. So there is, at the national levels, what countries, what low-income countries, what countries in Africa can do to better capture wealth. And to start with, I think many tax systems, as Ronald had mentioned, already have provisions for taxing wealth. However, many of these provisions, when you dig deep into it, you find that they're either inadequate, there are some loopholes, or they are poorly implemented due to lack of manpower and many other reasons. So prior to looking at introducing additional taxes for wealth, it's important to review the existing provisions for tax. And there are many countries that have gone a long way in doing this. So one of the propositions that Giovanni brought out was the establishment of high net worth units. So high net worth units have been introduced in several countries, as was highlighted by Ronald. And in Ghana, for instance, the high net worth unit has been progressively increasing its contribution to tax revenue. So in 2021, they raised $2 million. This was post-pandemic. In 2022, this was raised to $20 million US. And in 2023, this was raised to $37 million. So this particular unit has been performing well and is gradually increasing its contribution to tax revenue, and they are targeting specifically high net worth individuals. Staying on Ghana also, in their experience, they've shared how through their participation in the Global Forum for Automatic Exchange of Information, they've been able to better capture wealth that is owned offshore. So a lot of the offshore wealth has been better captured through exchange of information. And we've also seen that voluntary disclosure programs, as Giovanni had brought up, have also seen levels of successes. This is in Nigeria, South Africa, and in Ghana also. One of the findings that were interesting, staying on the national level, is that in contributing to the discussion around identifying wealth or describing wealth for purposes of taxation, there is a lot of things that need to be taken into consideration. So wealth may have a different meaning in African culture compared to Western culture. So I'll give you a practical example. Wealth in Africa can be used for symbolism and not necessarily for economic purposes. So there are certain tribes in Africa. So look at the Maasai tribe, that are in Kenya and Tanzania, the Fulani tribe that are in West Africa, there's the Tonga tribe that's in Zambia and Zimbabwe, and the Dinka tribe from South Sudan, and so on, many other tribes. They take pride in owning large herds of cattle. Now, if you're looking at it from a tax perspective, you can easily say, okay, they have so much cattle and we use them for wealth purposes. But culturally, the ownership of capital is not necessarily for economic use where they are slaughtering and earning millions on that cattle, but it's for cultural purposes. So there's nuances to describing wealth, and that conversation needs to be had on the African continent as to what wealth means for the purposes of taxation. So that is the conversation that we have been having at a national level. Then the second level to it is Africa's thoughts on wealth tax at the international level. Now, thoughts have been peddled to come up with a multilateral instrument that looks at taxing wealth at a global level. Now, the challenge with the global proposal that we have as a Pan-African institution is the redistribution of wealth. So a lot of the challenges with the global propositions around taxing wealth is that there is not a clear guidelines on the distribution of revenue from global minimum wealth taxes that will be accorded to African nations. And this is particularly worrying because a lot of African wealth is held offshore. Given that it is held offshore, will that money be redistributed equally to African nations? So there's two levels to the conversation. Of course, there's the national level where we strongly support efforts that have been outlined by Ronald and Giovanni, but then the international conversations that we're having at coming up with multilateral instruments to tax wealth, that's where concerns are raised. And going back to the question that we're asking internally as to how we got here, there's clearly structural issues that allow for this huge gap between the rich and the poor. And it's important to look at ways in which we can break structural barriers through opportunities like the FFD process and the UN process. So all in all, we strongly support efforts by African and low-income governments to better tax wealth through some of the existing provisions within their tax laws. And of course, there's experience sharing where some African governments have seen successes in that. And with that being said, I'll end my presentation there and allow for any questions that you may have.
Thank you, Ishmael, very much. You touched on both the national and international side, and I'd like to quickly follow up to get you to talk a little bit more about the global international side of things, partly because this has been really coming through the chat quite clearly. We had Gabriel Perez from Brazil mentioning the challenge of moving assets across jurisdictions which have more favorable taxation. Another question from Edwin Birich on one of the main obstacles to taxing the wealthy being, of course, again, offshore wealth concealment. So for me, all of that points to the importance of global tax rules. This is something that you've mentioned. You mentioned global institutions, exchange of information, the need for cooperation, but also the fact that many of those processes are still shaped and informed by colonial, neo-colonial processes and largely driven by the global north. So I wanted to ask for your reflections on the scope for multilateral cooperation, particularly in the current geopolitical climate, which in many ways is one of reduced trust in what multilateralism can do. So can you share your reflections briefly before I move on to the last presenters?
Yes, thank you so much for that. Yeah, I definitely feel that core to the conversation around taxing wealth is seeing how we can break existing structures. So fortunately, there are processes that are ongoing right now where we can put to question some of the existing structures. From a tax perspective, we have the UN Tax Convention processes that are ongoing. And these discussions mark probably some of the greatest changes that we're expecting to see in terms of international tax decision-making processes that have happened in decades. So this could essentially change the way international tax decision-making processes happen, where developing countries have more of a say, where we're saying, as African countries, we can bring to the table our concerns about taxation of wealth, for instance. And it's important to see how we can be part of some of these processes. Secondly, there's the fourth International Conference on Financing for Development, which is happening next month in Seville, where again, there's opportunities to look at domestic resource mobilization and international tax cooperation. There's conversations that are going to be had essentially where we can question the current system and its fit and see whether it is fit for purpose. There is also one of the other processes that we are part of as TJNA is the G20. So under the G20, we have an African country that is president. So that's South Africa. And one of the ways in which we're looking at pushing forth our interests is through the reform of the global financial architecture and critical mineral strategy. So there are these platforms that exist where there have been a lot of conversations around how we can break the current systems and financial and economic structures that have seen this huge gap between rich and poor countries, and where we can also push forward conversations such as the redistribution of wealth through how we tax it at a national level and then internationally also. So there is some level of hope despite how bad the situation is when you read through some of the statistics. But there is a certain level of hope and opportunity where we can bring forth some of these discussions. Yeah.
Excellent. Thank you very much for that, Ishmael. I'll get back to you along others towards the end. But now let me move on to the last presentation, which is shared by Umair Javed and Vanessa van den Boogaard. So I'll introduce both of them before passing the floor over to you. Umair Javed is Assistant Professor of Politics and Sociology at the Mushtaq Burmani School of Humanities and Social Sciences at LUMS, the Lahore University of Management Sciences. He did his PhD at the London School of Economics and Political Science, the LSE in the UK, and he has a strong track record of research. He was the recipient of the LSE Centennial PhD Studentship Prize. So we're very lucky to have you with us, Umair, sharing the presentation with Vanessa van den Boogaard, who's my colleague from the ICTD. She's a research fellow at the ICTD and a senior research associate at the Munk School of Global Affairs and Public Policy at the University of Toronto. At the ICTD, Vanessa leads the program on civil society engagement and informal taxation, and she has extensive experience in research and engagement and a strong track record on academic publications in tax and development, particularly informality, but well beyond that too. So their presentation will focus on we're moving to Pakistan now. So all of the cases we've heard so far are from the African continent. We're now learning from a different context and particularly a focus on public support for wealth and progressive taxes in Pakistan. I will have some questions from you. You will have seen that in the chat, this question of the politics of it all came through very clearly. So I look forward to your presentation, and I'll have a few questions for you after that. Over to you, Umair.
Yeah, thank you very much, Giulia, and thanks everyone for being here. So our presentation, this research, I mean, it's research that's still in progress. We're still sort of working through some of the analysis. But the motivation behind this is that sort of wealth taxes are increasingly gaining attention amidst sort of growing fiscal pressure, rising inequality, and declining aid. That was part of the setup that Giulia, you also mentioned at the start. And so one particular country that sort of faces a fairly standard problem of high debt and a narrow tax base is Pakistan. And in fact, just last week, when Pakistan sort of issued its federal government budget, about half of all total tax revenue is being devoted towards debt servicing and pension payments, right? So there's a real fiscal constraint that the country is operating under. And so wealth taxes are one particular instrument that can be used to sort of ameliorate this particular situation, but they've been proven fairly difficult to implement, politically speaking, right? Now, we know that there's elite resistance, but what we don't know much of is how ordinary people might perceive wealth taxes, right? And so we think that understanding public attitudes towards taxing wealth is critical, not just from an equity perspective, but also to identify when and how wealth tax reform might actually be politically viable. Sorry, next slide. So Pakistan has a sort of a truncated history with wealth taxes. Historically, wealth taxes were implemented in the 1960s. But they were almost immediately sort of hollowed out through various forms of exemptions that were issued largely at the altar of sort of elite politics and lobbying. So the most common form of wealth tax in the past were estate taxes, but you also had sort of more standard wealth taxes that existed. Most of these taxes were then sort of put off the books by the 1980s and 1990s. But recently, ever since sort of fiscal pressures have increased on the Pakistani state, there is a renewed sort of focus on bringing other forms of wealth taxation back into the picture. And in 2022, the government of Pakistan reintroduced something called the capital value tax, which was historically applied only on the transfer of certain type of assets. But this time around, in its sort of new incarnation, it was imposed on the actual value of assets that were held within a particular tax year. So this introduction of or this reintroduction of a particular type of tax shows that there is increased sort of attention being given towards wealth taxation. And while the overall contribution of the CVT is still fairly low, it shows that there is a potential opening that one can look at. So to assess both the viability of a tax of this nature and to look at what kind of sort of public support might exist out there, we carried out a nationally representative computer-assisted survey of a telephonic survey of 7,500 individuals as part of a larger project that looks at informal taxation and zakat in Pakistan. This survey had sort of again the overall sample size was 7,500 adult Sunni Muslims. The fact that these were Sunni Muslims has something to do with the fact that we were looking at zakat as part of our sort of one of the central questions that we were looking at. And the survey was designed to capture gender balance and includes questions on a range of tax attitudes, political beliefs, and socioeconomic characteristics. And for what we know, it is the first detailed survey of its kind in Pakistan that focuses specifically on public support for wealth and progressive taxes. Now, Vanessa is going to sort of lead you through some of the early results that we have.
Great, thanks. And yeah, I'll quickly go through from this data 3 sets of findings that we looked at. So first and interestingly, we find that support for wealth taxation in Pakistan is higher than we may assume, though it does vary a lot by tax type. So about a third of our respondents support a general wealth tax. Of course, this is not overwhelming support, but it's also not negligible either. But we do also see support is higher for certain specific reforms, and particularly those leaning towards more progressive types of taxes. So we see quite significant support for increasing the top rates for both personal and corporate income taxes. By contrast, views are more mixed on other measures to tax wealth. We take this to suggest that blanket measures to tax wealth may face resistance, but more targeted progressive reforms may be more popular. Second, we looked at who is more likely to support wealth taxation in Pakistan. And one striking finding here, again, I'm going to go through all of this really quickly, but can follow up in the chat as well. One striking finding for us, it really stood out, is that higher income individuals are actually more likely to support wealth taxation. And of course, this goes against a common assumption that elites are always going to resist such reforms, and I think opens up at least a conversation about the space that may exist for reform, coalition building that goes beyond just lower income groups. Continuing to look at the determinants of support for wealth taxation, but here controlling for income and other demographic variables, we find that the strongest predictors overall of support for wealth taxes relate to beliefs about the state. So those, first of all, who believe that wealth is too concentrated in Pakistan and that support redistribution in general are more supportive of wealth taxation, perhaps unsurprisingly. But even more important is trust in the state. So a respondent with high trust in the state is 15% more likely to support a new wealth tax than one who doesn't. But the biggest predictor overall is belief in the state's legitimacy. So ultimately, this shows us that support is shaped more by political trust, belief in the state, than on, for instance, views on current government performance. Now, given the importance of trust and the reality that in Pakistan, about 2/3 of our sample have no or very little trust in the national government, we further, and the final point that I'll make today, we explored how policy design shifts may increase support for wealth taxation. And here we first find the importance of being clear with citizens about measures to protect lower income earners and to target higher income ones. So for example, we find that public support for inheritance taxes increases significantly when they're clearly communicated as applying only above a certain threshold. Inheritance taxes in Pakistan are often assumed to be wildly unpopular. And, you know, indeed, when we do just ask people about the potential of an introduction of an inheritance tax, the majority of respondents disagree with it. But we can also see that support jumps when we clarify that a proposed inheritance tax would have a minimum threshold. So this suggests to us that it's not just the idea about an inheritance tax itself, but concerns over fairness and who's affected. Now, of course, many inheritance taxes, I would venture to say all inheritance taxes include thresholds already, and often these are quite high, but communicating them, we see this across different contexts, is often a challenge. People often don't know who is actually affected by these types of taxes. So for us in contexts like Pakistan, where trust in the state is really low, this really reinforces the point that clear communication about the fairness of policy design isn't just good practice, but is actually will be essential for building support for these types of reforms. And we further found that support for wealth taxes increases significantly when people believe that the money from these taxes will be spent well. So in our survey, we tested different variations of a wealth tax, one with revenues earmarked for redistribution to the poor, and another involving taxpayer input on spending. And both saw much higher support than just a general wealth tax without those specifications. So again, in a low trust environment like Pakistan, this reinforces the key message that people are more likely to support wealth taxes when they see transparency, accountability, and responsiveness in how revenues are allocated. So we went through that very quickly. I think we are still relatively over time here, but just to sum up quickly, 3 key takeaways from this initial data analysis, which again we'll follow up with a paper soon. First is that wealth taxes in Pakistan aren't uniformly unpopular. Targeted progressive reforms may receive broad public support. So this to us suggests that there may be openings and windows for overcoming political resistance for targeted reform. The second is the point that clear communication about policy designs for fairness and progressivity are essential to ensuring broad-based support, and that this broad-based support is necessary to address the politics of reform and overcome those political obstacles that we've been discussing. And third is the point that trust in the state is essential. So without it, it doesn't matter how well designed the reform is, it will struggle to gain support. So certain policy designs, perhaps those that include targeting or at least include measures of transparency, perhaps citizen input, may help to build legitimacy and public backing for wealth taxation, even in low trust settings like in Pakistan. So I'll leave it there for now, but hopefully we'll get into more detail in the discussion.
Thank you very much, Umair and Vanessa. This was great and somewhat reassuring, your results. I really liked how you talked about fairness, transparency, and clarity in communication. And I wonder if you can perhaps elaborate a bit more in response to a couple of questions that came through the chat. So one was from Gabriel Ferraz from Brazil, who brought the example of resistance to progressive reform in Brazil. And he was asking, how you can mobilize public support for reform. What does a successful campaign look like? So that's the first one. And the second one is from Promise Ofoa from the African Center for Tax and Governance in Nigeria. And quite rightfully asking the question that really lies at the heart of the politics of it all, which is, how can progressive tax reform succeed when those making decisions are the very same people who would lose in terms of tax payments from greater enforcement of taxes on the wealthy? So it's up to you whether it's you, Vanessa, or Umair, but it would be really useful to hear your reflections in response to those two questions.
Yeah, sure. I mean, I maybe can give a minute, and then Umair can jump in and maybe give a bit more about what this could look like in the Pakistani context. And I'll try to make it short. I think that there's a lot that could be said here. This is probably a whole other webinar on kind of gaining popular support and addressing the politics head on. But we have seen some cases, and I can share some of these in the chat, of building reform coalitions for politically unpopular taxes. So thinking really carefully about the role of civil society, but of also gaining a broad-based coalition that can move some of these conversations forward. I think, as we showed in our data, this can involve higher income individuals as well. This isn't something that is opposed universally by economic elites. So thinking about how to go about doing that, there are a lot of lessons about the role that civil society can play. But I think for me, at least, a key point here really is in the clear communication and the transparency. First of all, the transparency of presenting data. I think as we have discussed, the different measures that we can use to identify wealth and really draw attention to inequality as it exists in society, and making clear the impact that has on individuals and on the way that the state functions, what the state is able to provide for people as a result of that type of inequality, and the potential that new revenues could have for public service delivery. Another key aspect, I think, is in the communication about what the wealth tax itself looks like, or the ways to tax wealth, if not specifically a wealth tax. And I think that some of the lessons that we've seen in other contexts, including one example from the US that I put in the chat, but I have some others too that I can share, about the importance of framing and language. So often talking about wealth taxation is unpopular, but talking about other ways that we can make the tax system more progressive, talking about fairness, talking about, again, the tangible links that this can have for people, for the services that they have access to. I think we have seen in different contexts that can make an impact to start to build that broad-based support that can at least, I'm not going to suggest that it can. The second question, I don't think it can necessarily address the problem that those that are making laws and implementing them will be affected. I think that's going to be a perennial issue, but continuing to put that pressure from different angles is at least an important first step. Umair, I don't know if you want to add anything there.
Yeah, just very quickly, I think in Pakistan's case, I think one of the openings that the current moment actually provides, so there are two openings. The first one is that Pakistan has been in a pretty strict IMF program for the last 2 years, and they've been able to push through some sort of revenue measures which were otherwise perceived as unpopular, but it turns out that they were able to sort of get them through. So that, I think, in some ways it offers political support to reform-oriented decision makers that they might actually be able to do something like this, and it won't necessarily have the backlash that they think that they might face otherwise. And the second thing is, because the tax base currently is so narrow in the context of Pakistan, that the opening up of new instruments might actually reduce the tax burden and split it more widely across the existing tax base altogether, right? And I think that really is something that people might actually be quite keen on. So when it comes to sort of what Vanessa said, communicating clearly about what this new tax would entail, if it can be established that this is, that it improves progressivity, it improves fairness in the tax system, I think that very well could be something that that enables people to sort of add support to it. But yeah.
Thank you so much for that. I'm conscious of time, and I think in the context of the conversation, many of the questions coming through the chat were either answered. I can see 15 of them were already answered in the Q&A box, but also many of them were introduced into the conversation as I tried to throw them at you presenters as you were speaking. So I would be tempted to now thank you. I'm going to come back to all of you for a final round. I'm going to let you decide if you want to give us your one key takeaway message, or if you perhaps want to pick on some of the questions that remained unanswered in the chat. I think there were a few really good questions that we haven't got to about, for example, there was one from Chinyama Hamachila about the balance between maximizing revenues and incentives for attracting investment. I think that tension between revenue generation and growth is one that I'm hoping one of you can perhaps pick up on. There was also a question from Rufus Seyon about, is it more technical or political after all? And I'm sure that at least one of you will touch on that. And finally, one from Michael Agaziza from Zambia about what does it all mean for other taxes, and the broader revenue mobilization project. So it's up to you whether you want to pick those up or other ones. I'll go in the same order. But before I do that, I'd like to thank you all very much. It's been incredibly insightful for me. And I think we started off this conversation with a slightly, pessimistic reflections on what's happening in the world, not only in development, but of course in the world more generally. And I think I'm coming out of this conversation with a bit more optimism that things are possible. It is possible to increase revenue now. It is possible to do it equitably. It is possible to do it efficiently. And taxing the wealthy is the obvious place where to start. But I think at the time when tax increases are inevitable, and in many ways the whole development process and the whole of development finance hinges on the success of the tax mobilization agenda, it is also true that alongside taxing the wealthy, we have a wealth of other experience and evidence and knowledge about what works and what doesn't. And it's really important that in this new era we make the most of it, because I don't think anybody, government, citizens, civil society, development partners can really afford to not make that evidence count, because the space for reform is narrow, and it is important to make the right decisions now. And luckily, we know what works and we know what doesn't, as researchers, as governments, as practitioners, as civil society. So we're building on a very strong foundation for this new era. The obstacles are there, but I really liked how we ended this conversation around concrete suggestions and perhaps new opportunities for overcoming what have been so far been obstacles. And I do think that there are openings now that perhaps are new. So with that, I will pass over to Giovanni, Ronald, Ishmael, Umair, and Vanessa for your final remarks, and we will then close up, hopefully just about in time. So over to you, Joe, to start with.
Thank you very much. I think I'll try to make my final remarks, picking up some of the things I put in the Q&A to different questions. Two things that I really want to underline. The first one is about data quality, which is something we have talked about a lot here. And I think that it's very important to stress that, this is a situation in which, perfection can be the enemy of the good. As Ronald said, there is a lot of information the revenue administration already have in their hands. And using this information can already allow the identification of hundreds and hundreds of individuals in all countries that should be paying more taxes than what they are. So I think that this is to me the main reason why every revenue administration in the continent of Africa, but also in other low-income countries, should start doing all of this tomorrow. Okay, the pressure is here, and this can really be done in the space of a number of months. Results can be seen quickly, and as you see results, then you can mobilize more will to do even more. And one of the questions was, are technical obstacles stronger than political obstacle? Political obstacles are always stronger at the start, but if you can show that there is a real consequence for how much you can mobilize, then they decrease over time, right? And at the start, not having enough resources to even attempt doing this is in itself a political obstacle, right? So some of these divisions are more abstract than practical. So yeah, I think this would be my closing remark. There really is the potential to address the unfairness of the tax system by working with what we already have, and given the scarce political capital available to improve revenue mobilization, this is where we should all start. Academics and practitioners and civil society, we should all work together to make sure that this happens as quickly as possible. Thank you very much. It was a pleasure.
Thank you. Ronald?
Yeah, I think I'm not very far from Giovanni. I think at times it is just important to just begin, not wait for perfect definitions, perfect IT systems, perfect processes. I think tax administrations in Africa, they just need to decide to start. I remember when Uganda started, they started by identifying high net worth individuals using public and available information. They knew who the rich are, and they just started with a random number of 117. Now they have 1,629. So at times it is important to just begin. Secondly, I think effectively taxing these HNWs will require a balanced approach. One that combines regionally informed standards, especially on EOI, exchange of information. I think this still needs to be marketed on the African continent. Like I said, only 5 countries are approaching or are already having automatic exchange of information. This needs to be implemented. But this also needs to be tied with national strategies underpinned by stronger digital infrastructure and effective data integration. Thank you.
Thank you. Ishmael, over to you.
Thanks, Giulia. I'm very much in line with Gio and Ronald, and I think there's 2 things. I think there is taxation of wealth at national level. For me, looking specifically at the African continent, I think a lot of questions have been raised about the political dynamics of it, and it's not just in Africa. We have seen in more developed countries like the US, for instance, where billionaires such as Elon Musk have pushed for certain taxation rules that favor the rich. So this is a problem that cuts across, and even in developing countries. And as Ronald said, I think it's important to just start within the tax administration, where it is less political. We have seen, like in Uganda, for instance, their high net worth taxation unit have specific people that focus on what they term as VIPs. These are the politically exposed people, which is the same in Ghana and the same also in Kenya, where they have specific people that look at and deal with politicians, where they try to navigate the dynamics and the politics around taxing high net worth individuals. So we have this opportunity now where we are looking at dealing with growing inequality on the African continent. And this is one of the solutions put forward and opportunities that we can to better tax wealth. And second, I think it's important to look at the more systematic reasons as to why we have this huge gap between the rich and the poor. And there are opportunities at the multilateral and international levels where we can bring forth conversations to say we need to change this system that allows for the exponential growth of millionaires and billionaires, and allow for tax to play its redistributive role within societies and within jurisdictions. I'll end it there. Thank you.
Thank you very much. Umair.
Yeah, thanks very much. So I think based on sort of the conversation that we've had, I think the political aspect of implementing some of these taxation measures, I think that remains crucial. But one thing that I find encouraging, both from the experience of the case studies shared by the earlier speakers and also from our research in Pakistan, is that there are coalitions of support available for those measures. And I think harnessing those coalitions of support for reform-oriented policymakers is central. It's essential, and it makes the task seem more doable than what it might otherwise be perceived as. So I think to make it politically feasible, policymakers and decision makers will have to cultivate those coalitions of support through clear messaging, through clear communication. But that actually would allow some of these measures that might seem unpopular to actually be implemented in the first place. And that really goes a long way in resolving one of the central problems, which is usually elite opposition or various forms of political opposition to such efforts. But yeah, thanks.
And Vanessa.
Great, thank you. Yeah, I get the last words. I think I could reiterate a lot of what has already been said, but I think that's one point that I do want to reiterate is the opportunities that exist right now, and I think the political opening. I think drawing on what Giulia said, I think that we know that the context is shifting globally, but in many countries, the public popular narrative is shifting. There's an increasing recognition that looking for self-sustaining revenue is critical. Not waiting for aid is no longer an option. So thinking about this as a real moment at this time, and I think that we see this in Pakistan of how the narrative has been shifting. We see it in Ghana, where I also work. I'm sure that this is also happening in other countries. So I think it's really the onus on local actors to really take this moment as it exists before that window may close. Now, of course, that doesn't address the politics, and I'm really happy that came through in the chat quite strongly. So I think maybe to Rufus's point about the technical political challenges that exist. I mean, one of the areas where I think that this is both a challenge but also a clear opportunity is in thinking about what Umair said about the coalitions of support that already exist. How do you identify those? How do you harness those? How do you build those so that they grow? I think one of the issues that we've seen, I think in tax in general, but in these types of taxes is thinking about the fact that resistance to these types of taxes is very concentrated, but it's also very loud and very powerful. There may be wider popular support for increasing fairness in the tax system, but the reality in many countries is that people aren't that engaged in taxation. People don't know that much about taxation. I know that this is the case in my country, in Canada. People are not, tax is boring, tax is technical, tax is esoteric. Thinking about ways then to communicate with people, to make tax more accessible, to make the impact of reforms for greater fairness, progressivity, redistribution more tangible and accessible to people is something, again, that we have seen success with in other countries, thinking about the role of civil society in mobilizing taxpayer engagement for a topic that most people don't actually want to talk about. I think that another final point that I want to make, drawing on Felix's great comments in the chat as well, is really the point about needing to be clear about how those revenues are spent. Of course, I think that this is an issue, again, not just with wealth taxation, but of thinking about popular support for taxation in general. We say often at the ICTD that increasing revenues is not an end goal in itself, right? It's not a good in itself unless those revenues are being used for redistribution, for public service provision, for improving the lives of people in country. So it's really thinking about reforms to make accountability stronger, to make transparency of revenue expenditures or of expenditures clear. And I think the point about extending social protection is a useful avenue for thinking about that. And we have lessons from many countries about what that can look like, and particularly the importance of ensuring that coverage reaches the informal sector, which of course is large in many countries. So yeah, I think I will leave it there, but it was a really, really great discussion. And I think the chat has been lively as well. So thank you everyone for contributing.
Thank you very much, everyone. I think it's really important to keep in mind that what we've learned is that this is not only taxing the wealthy more effectively, is not only technically feasible, is not only equitable, but I think it's also not necessarily going to face that trade-off with investment and growth. And this is one of the questions that came through. So I wanted to quickly touch base on that. And the reason is that when you generate more revenue in a context where budgets are so constrained, you can actually pay for things that investors want to see. They want to see investment in things that are useful for their employees and their staff, healthcare, good infrastructure, digital and physical, good education systems, good professional training programs, and so on. And these things are paid for by taxes. So ultimately, the two things, generating more revenue through taxing the wealthy and attracting investment, are really not at odds with one another. In fact, tax revenue mobilization is what enables entrepreneurship and growth and investment, because there isn't enough of it to provide the kinds of things that investors want to see. So I think that is also useful to keep in mind. I have no doubt that the discussion on politics will continue. Resistance will continue. But I think it is increasingly clear to me that, if research is showing the foregone revenue involved, it is showing the ways in which this is possible. So it isn't true that it cannot be done because of political resistance. It can be done, and it is being done by several countries. There's a great deal of experimentation across lower income countries. Civil society is increasingly active, sensitized, mobilizing engagement across citizens and organizations, and coalitions are being formed. So political resistance will remain, but all of those things will make it easier to confront that resistance in ways that are actually beneficial for society as a whole. So I'm going to close off on this rather optimistic, but still very realistic note. And I look forward to continuing the conversation after this webinar with all of you. Thank you.